All right, let's talk a little bit about market structure. Market structure is not so different from candles in that, it gives you a ton of data just about, what the market's doing. Where candles we're looking at, one single piece of data kind of, on a small time frame. Market structure is taking kind of all that information and putting it all together to create a trend, essentially. And so starting off with why market structure is important, like I just said, it helps us identify trends as well as patterns, and we'll get into actually some of those line patterns in a bit. But more importantly, if we understand market structure, it's going to help us identify buying opportunities as well as selling opportunities. And even further than that, it's going to help us prepare for future opportunities, because if you're watching market structure, you're always thinking a step ahead. You're always planning for the what if this happens, what if that happens, and market structure is the heart of that thought process. Market structure is important for identifying macro, intermediate, as well as micro market direction. And so there's a bunch of different trends, and those really just come down to essentially what those are is market structure on different time frames. Again, we'll get into that in a bit, but just know that there's many different levels that you can look at market structure on, and which one really matters to you comes down to your specific trade plan, your trading style. And then at the base of it, there are three different types of market structure. We have uptrends, we have downtrends, and we have sideways trends, which is essentially a lack of a direction. So if we start off, all of these trends are just going to be based off of highs and lows. And so highs and lows are places where the price action makes major pivots. And so on this image that's here, all of the major highs and lows are circled in orange. And so we have a high here, we have a low here, a high here, a low here, high here, low here, and another high here. Of course, there are more things that are going on here, but these are just marking the major pivots. One thing that's important to know about highs and lows is that they are always compared to the previous highs and lows. And so let's go through that again. And so we have a high here, a low here, a high here. If you notice, this high is lower than this high. That would be considered a lower high. And then we have a low here, and this is slightly lower than the previous low. This is also a lower low. Another high that is lower than the previous, and so this is a lower high, lower low, lower high. It's just important to keep that in mind. And you will often see these abbreviated where higher highs are just abbreviated HH, lower highs are abbreviated LH, higher lows are HL, lower lows are LL. It's just important to be able to identify those, and we'll go through how to do that in a bit. But just know that all of the uptrends and everything that we're about to talk about is based off of these things. It's based off of highs and lows. And so going into our trends, we have our uptrend, which is a series of higher highs and higher lows. And this trend overall is bullish. And we can think about why that is if we think about, the market sentiment that's going into this. People are willing to pay a higher price. And so if we follow this price action, we can see that we have the higher highs marked here, higher lows. So we have a high, a low, a higher high, higher low, and this is going to make a higher high as we're already above the previous price action. So think about the market sentiment that's happening here. People are eager to buy. And what that means is that as this makes a higher high, people are jumping into this sooner. And so this low doesn't get back down to this low. And so people are willing to pay a higher price, and that drives it up even higher. And then secondary to that is people are willing to hold on to it longer and aren't as eager to dump their bags. And so what that means is that people that are buying on the lows, they're not so eager to sell at this high because there's so much momentum happening that they'll hold it, take profits at a higher high, comes back down to a higher low, and the same thing is, rinsing and repeating. And so we have a bullish uptrend. On the opposite end of this, we have a downtrend. And this is a series of lower highs and lower lows. And this trend is bearish. And again, it's pretty much the exact opposite, and we can follow this line here where the price is coming down. We have created a low. We've created a high. This is a lower high because this price came from somewhere. We now have a lower low compared to the previous one, and that forms a lower high compared to the previous one, and this is continuing down to make a lower low somewhere. And again, we can think about this market sentiment in the same way. People are willing to sell at a lower price, and so this lower high happened or this high formed lower than the one before it because enough people sold. The seller strength was much stronger, and so the price never revisited that again and just continued to go down. And so what that means is that nobody's jumping in to buy, and price keeps getting pushed down. And so if we form this high and the price is coming back down and revisits where this low is, why wouldn't that reverse? It just means that the buyers weren't there for it. Nobody's jumping in to scoop this up. Nobody's feeling like that's a bargain price at this point. That now doesn't happen until down here where enough people say, okay, now I'm interested in it. And then it goes up a little bit, but it doesn't revisit the other high. And so that just means that people are also really eager to get out of that token, or they are wanting to sell it, or they're, scared of the market for whatever reason. And so the price is continuously getting suppressed. And so in between the uptrend and in between the downtrend, we have a sideways trend. And so this is just a series of even highs and even lows. And really what this means is that the trend is just indecisive. People are uncertain. These often become kind of consolidation periods. These don't necessarily have to happen at a particularly high price or a particularly low price. They can be, pretty much anywhere. But it's just an idea that the market is kind of, reevaluating which way it wants to go. So what I mean by that is that this price could have came from, higher highs, higher lows, and then start just kind of consolidating. The opposite could have happened where it can come from lower highs and lower lows and come down, and then it consolidates. And it's basically a point where the bulls and bears are battling. And that is really the market sentiment to think about, is that the price is just going from the same lows to the same highs, to the same lows, to the same highs, to the same lows. And so there is no directionality. And if that, there's a lot of people that just take that and say that they're just not interested. Consolidating market is indecision. It does not give them any trading advantage, and they're not interested in that. But uptrends, downtrends, sideways trends, that's really the only three directions that it can go. Anything that doesn't fit those is really just not a trend. And so back to kind of going full circle here and going back to why these are so useful. Market structure is the first step in knowing the direction of a trend. And why that's important is because trading with a trend will always yield higher success. And it's just because, based on, we can look at this uptrend here, you have more uptrend time than you do downtrend time. And so your trading periods are longer, but also, there's people that just trade higher time frames and will buy into these higher, buy into a higher low, and they can just hold it. And so going with the trend is always just a better bet. And there are people that I know that will do that, and I will often do that with some of my strategies, which is that, if the intermediate trend is an uptrend, I won't short the market. I will just wait until a downtrend starts to short, and then I won't long the market. And it just makes it so that you're not tracking too many things. You're kind of just staying focused on, the easiest win rates, and that's really the important part. And so going a little bit further into, some of these other ideas, identifying a potential change in market structure is an excellent sell strategy. And I do want to really focus on change in market structure, because being able to identify a trend is equally as important as being able to identify a change in a trend. And so what this means is that, we have an excellent sell strategy here. And so pretty much what this tells you is that if we follow this trend here, we have a higher high, a higher low, higher high, higher low, higher high, higher low, lower high. When a lower high comes in, think about the market sentiment there. What does this mean? And again, you won't know this is a lower high until, it actually prints this lower high a little bit and comes down a bit. What that means is that people were more eager to get rid of their holdings, that the buyer strength was not as strong as the seller strength. That is a perfect indication of a change in trend. And so some of the people that, their strategy is to, just ride a trend can buy a higher low or a higher high. And so let's imagine that, this higher low prints, it breaks above this higher high, and somebody enters here. They ride it to the higher high, they ride it to a higher low, they ride it to a higher high, they ride it to a higher low. Lower high hits, and they sell here because that lower high has been printed. They now just made, whatever the difference is from here to here in profit by just writing that out and just watching a market change or a trend change. On the other end, identifying a change in market structure is also the best way to prepare for trades. And so even if you are not trading this uptrend and you're watching it, you're saying higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, lower high. The second this prints, even if this breaks through, what you're basically watching is you're watching for the next lower low and lower high, because you know that lower high is going to be a good opportunity to trade the downtrend. And so a higher low comes in, higher or lower high comes in, this already breaks through, and you say, okay, this is a lower high. If this just broke through, we're now going to make a lower low. And so you wait for this lower low to print, and then you're just waiting on this lower high to print. And so you don't have to trade any of this stuff. You're just identifying a lower high, lower low, and you take the next lower high and you ride that. And so that's why this is, super, super critical for the grand scheme of things. And this will probably make more sense when we look at live charts in a second. But just understand that, that's a few strategies that we just looked at really just based on market structure.